So just before we turn everything over to Peter Kinch, a couple of reminders for everyone. So we've got the Our Place breakfast and lunch tomorrow. We're still looking for a couple of donations to cover the cost of the breakfast and lunch. And Carolyn, myself, Lori, and I think a couple of other people have volunteered to go down to Our Place and serve breakfast and lunch to people who are in desperate need of some good, healthy food and some good company. So if you're around or you want to make a donation, let me know, and I will happily take your money. And so that's tomorrow. We just need to confirm the time, and then as soon as we've confirmed the time, we'll post it in the Facebook page. You would think we would know that by now, but I don't know it yet. So we'll confirm the time and then we'll get that up for you. So next week, of course, is happy hour. So we'll do our Ren happy hour, second Wednesday of August. Then on September 24th, we have a full day real estate event that we're hosting out at the Langford Business Center. And of course, tickets are available for that. It's free for Ren members. And we've got an Eventbrite site, so I'll send that out for everybody who wants to share it. There's a couple of things that I'll bring up at the end of our session. We've got some good opportunities. Donnie Dunlop up in Grand Forks. Jeff's going to go see her this week. She's got a bunch of really interesting properties up there. We have the Quinnell 16-unit townhouses under contract. So Stefan's going to be working through that with Jorian. Of course, we've got Souk for sale. We've got 4 10-acre parcels, and I still have 1 spot left at Crescent. So if somebody wants to come and join us in this gorgeous beach location, we still have 1 spot left. So let me know if you're interested in that. And other than that, like I say, I'll give some more information about all of those things at the end of the session. But in the meantime, I want to give the fabulous Peter Kinch as much time as possible to share with us some information about where we are in this crazy market and why it's such a good idea to start diversifying and looking at the exempt market. Lots of people right now are feeling uncertain, and I use that word. It's one of my favorite words. And it's one of my favorite words because I've learned that my largest projections and momentum forward has always come in my personal times of greatest uncertainty. So I think uncertainty and crisis and change always brings huge opportunity if you're willing to step out and take it. And so as Ren members and friends, we're all about collaboration. We're all about learning. And so it's always great to see where the opportunities are in these very changing times. So Peter has been someone who has been in the industry for many, many years. He's going to probably give you a little bit more detail about his background, but he's been a mortgage broker. He's in the exempt market. He's an investor. We met through RAIN. God, that must have been about 7 years ago. Lots of the Ren members have investments with Peter. And a lot of people that you talk to will say, yes, I changed course in my investing profile because of my discussions with Peter. So that's a pretty big testimony, just that alone. So thrilled that Peter's joining us today from Dublin, Ireland, where he's writing a book. And it's just to be sure, it's great to have you here.
Top of the morning to you.
Top of the morning. So
well,
Peter,
it's evening here, so it's good.
Yeah, that's right. It's evening. So Peter, it's the floor is yours. Educate us, Kimosabi.
Well, thanks, Liza, and as always, it's just a pleasure to be with you guys. And I guess it's funny, you were talking there, and that's one of the Warren Buffett quotes jumped to mind. Be fearful when others are greedy, and greedy when others are fearful. There's a lot of fear and uncertainty in the markets right now, that's for sure. I'll tell you one thing. I've been in, as you mentioned, mortgage brokering. This is I'm almost afraid to use the number. I've been just going with 25 years, but it's actually more than that now. So over 25 years as a mortgage broker, and the bulk of that was working with real estate investors. And over the past 5 to 10 years, realized that there was really ultimately a big gap when it came to investing in general. If you think about the average Canadian, and by the way, that doesn't include anybody on this call.
No average Canadians here.
Yeah, y'all ain't average, okay? You're above average. And but when you think of the average Canadian, and they have whatever finances money they have, they typically go down to a bank, work with the financial planner, and the traditional thing. Hey, the traditional thing has been a 60-40 split of stocks and bonds, right? Well, you look what happened in January with Russia invades Ukraine, and all of a sudden your stock market just starts to go tanking. I mean, with a few rare exceptions, a very good portfolio manager will be bragging because he only lost you 6% this year so far. So if you lost less than 10%, your portfolio manager is really happy. The benchmark, I think, is between 15 and 20% losses in the stock market. Now, I want to start by saying that this is not me bashing the stock market. That's not the case. But the reality is suddenly that happens, geopolitical events happen, and then interest rates start to go up because we're faced with runaway inflation, and inflationary pressures cause central banks around the world, not just Canada, to start raising rates. And when you raise rates, you create an inverse relationship with the price of bonds, and ultimately your value of your bonds starts to go down. So there's negative returns in bonds. This is actually a rare combination. You don't typically have a negative return in bonds and a negative return in the equities market at the same time. So it's causing a lot of people to be fearful, and it's causing a lot of uncertainty, as you said, Liza, in the marketplace. And but it's interesting, if you're dealing with the average person who's dealing with a typical, either their bank in mutual funds, or they're dealing with even if they have a very good portfolio manager, these are difficult times if you're not diversified outside of publicly traded products. And that's really, if there's a word I'm going to use a lot today, and something I'd encourage everybody to write down, it's the term non-correlated. Non-correlated products. And what non-correlated means is just that when one thing goes up, it doesn't, the two are not correlated. So again, Russia invades Ukraine, the stock market reacts, and stock market goes down. Well, Liza, you're everybody who's invested with you knows that Russia invading Ukraine had no impact on real estate values in the projects you guys work with, right? It may have an impact. Well, rising rates and inflation may impact it, but not geopolitical events per se. So that's what we mean when they're not correlated to each other. So going back to what I was saying earlier, the big thing for me was to look at the financial market. And one of the big gaps I saw was you had financial planners, portfolio managers, mutual fund industry on one side of the fence, and you had the real estate industry on the other side of the fence. And there really wasn't anything that ever bridged that gap, in my opinion. Everybody who is big on real estate, whether it's the RAIN groups or go back to the Raymond Aarons of the world, it's like, real estate's a much better asset. You should put all your money into real estate. And the financial planners of the world are saying, well, that's really risky. You can't put too much in real estate. You got a house already. You should put money in the markets, and let us manage it. And my approach was to look at that and ask myself a simple question. Well, what do pension funds do? What do university endowment funds do? What do institutional funds do, and high net worth individuals? And what was interesting? None of those groups I just mentioned do one or the other. They have a hybrid. They mix it up. They have access to the public markets, and even your Canadian pension plan buys billions of dollars of real estate, and they also invest into private equity, private companies. So that's where I got the idea, Liza, about 7-8 years ago, to diversify my mortgage business and get my exempt market license, which gave me the ability to work with portfolio management firm. We work with Newport Private Wealth for those who want portfolio management. And we work with private equity, select companies that we can work with that are real estate backed, but also eligible to put into your RSP or your TFSA, but they don't trade on the stock market, and therefore they're not correlated. And as a result, I'm very happy to say every phone call I've had with my clients for the past 7 months has been to tell them, oh, you made more money. Your portfolio has gone up. compared to the same call they're having with their portfolio manager who says, we only lost you 6%.
That's a nice, those are nice calls to have from you, Peter.
Yeah.
Much nicer than the, and I've actually had people who have been calling me with those, you know, my mom, her ex-husband, you know, she just looked at his statement and she's like, Liza, Ernie lost a whole ton of money. I'm like, yeah, not surprised. So yeah, so it's very exciting to know that there are other options, and especially when people are feeling insecure about, you know, going out and buying like that one property as an investment, right? That one door, you know, the one condo or the one single family home investment. It's like, okay, this is the time when people are really starting to think about, is that the best thing for me to do? Or if I already have that, how do I diversify from that? So I'm glad that that's what we're talking about today.
Yeah, and if there's one theme I want to really, if I was going to put a label on what this conversation's about, the theme is diversification. And it's really not about saying this is better than that. Okay. It's about, well, it doesn't have to be one or the other. Have a hybrid mix. Your portfolio should have a balance in it. And, you know, when I work with my clients, one of the things I do to help identify that portfolio or that balance and what that should look like is through the gap analysis. And I know the last time we did a call, went through the whole gap analysis. So I won't do that again. I might, for the benefit of those who hadn't seen it before, I'll touch briefly on it if you don't mind. And, you know, a gap analysis is just a way for me to identify what's important to you. Because, you know, I'm sure a lot of people on this call have dealt with someone who might have been selling a specific product, and they're, for lack of a better term, they're a sales rep for a company. Then they're, you know, their motivation on one level is to try to convince you to invest in that product, right? And that's how they make their living. And there's nothing wrong with that, but it's important to distinguish what it means if you have an exempt market dealer's license, and that there's a, I actually have to be accountable to the Securities Commission. So part of being accountable to the Securities Commission is I need to know my client. You know, the Securities Commission could come along at any point and say, Peter, why did Liza put this much money into this company? Or why did this individual put way too much of their disproportion of their overall assets into one private company, you know, without liquidity? You know, those are types of things I always have to be accountable to that. So it's important. So one of the ways that it helps me do my job is to do the gap analysis, because that helps me identify where you are, where you're going, and what your plan is to get there. So on that note, I'm just going to share what the gap analysis here is. And Liza, let me know if that shows up on the screen.
Yep, it does. You just, I think depending on how people are looking at it, it might be, let me just.
Really small.
No, it's not small. It's just, there. Yeah, it's just there. That's good. That's perfect, actually. I think it was the way I had my Zoom set up. So it was just, it's great.
Perfect. You know, I'm not going to, again, we're not going to go through the whole, everything on here. I just wanted to touch base on what the gap analysis is. And it's a very simple process where we analyze a complete inventory of where you are today. What's your current, you know, age and lifestyle? What's your current budget? What are the current income sources? What are the current investments that you have? And, you know, we can quickly kind of just go through. And as I like to say, it's literally, just going to shrink that a little bit. It's literally an inventory of where things are at today. So this left-hand column is just an inventory. And I would suspect that most people are REN members, have a good handle on where they're at and what they have. And so, but you know, you'd be surprised. Sometimes people are, you know, got things all over the place. But and maybe you've gone through a life event, you know. It could be a change in jobs. It could be a divorce. It could be a death of a spouse. It could be a retirement of your own retirement, or you just, you know, somewhere along that line you're planning for where you are going to be in the future. So I have two more columns here. I always project out to the third column. And the biggest thing I want to know when I'm working with somebody is, what is your goal? So let's just throw an age out there. Let's say you're 50 years old today, and you can pick any number and say, well, I like to use the term, and Eliza, you know this, I don't like to refer to retirement. I like to refer to it as work optional. When do you want life, when would you like work to be optional for you? Instead of perhaps saying, when do you want to retire? And that just means when you work because you want to work, not because you have to. And in order to facilitate that, your investments have to kind of cover the bill. And so I take this right out to this column here on the far side would be probably 70 years plus, where you're probably not doing any form of work. You're living off your retirements and or pensions. So again, you want to identify what that lifestyle would look like. What would it cost you on a monthly basis to live the life you want to live at age 70 plus? And then what are your income sources? You're going to have CPP, OAS. Did you have a pension coming in from the employment that you had in your career? Yes, no, or maybe. If you're self-employed, by the way, the answer is no. You have to self-fund your pension. That's another good term to write down, self-fund your pension. And then, you know, really all we're doing here is saying, you know, okay, so let's say that my budget, the goal is I want $10,000 a month. And I add up my CPP and OAS, I add up various pensions, and I see that I'm only going to have $3,000, then you know what? Obviously, my gap's going to be $7,000 a month. And then, okay, now we know that every action you take here today, right, with your current assets that you have today, the inventory we did, has to result in generating enough income to address a future gap that you may or may not have. Okay. And that math, by the way, is surprisingly simple. Not everybody does it. You'd be shocked. And I'm actually shocked how few financial planners actually do it. But again, once you identify what that gap is, then my approach is to reverse engineer it so that every action you take today is consistent and congruent with the objective and the goal that we've established here. Now you might say, well, what's this whole middle column? Well, there's usually a bridge between 70 and where you are today. This might be your work optional, where you quit your day job, so to speak, and maybe you have a project of business or something that you're doing, or maybe you just you own your own business and you sold half of it, or you downsize and you've got less income than you had when you're working full time, but you're not fully retired yet. So there's typically a bridge in between these years. So it's a current inventory where you're at, the bridge, and then the end result. What do you want this all to look like? And one of the biggest things that I focus on is making sure that you don't, I use the term, cannibalize your assets here and start spending your investments too early to satisfy a semi-retirement in the middle at the cost of not having enough income at the end.
I like it, Peter. And I know many of our REN members have done a gap analysis, and I think that many of them would say 70, I'm retiring at 60, or I'm retiring at 55, so.
Well, to be clear,
work optional.
You're probably work optional at 55, but you're probably doing, the majority of people I work with are very industrious. They don't sit around twiddling their thumbs.
Exactly.
So doing something.
Yeah. I'll be in Mexico running my empire from the beach with a tequila in my hand.
There you go. Exactly.
So that's the gap analysis that you and I will do together. Is that's where I'll be, five years from now. We got a lot of work to do.
There you go. Well, now we have a goal. And that's it. You got to start with the goal. So, when I do this process, it just helps me identify, honestly, it just helps me identify, what your needs are, and then we can build a plan around it. And I think that's all. I'm not going to belabor the whole gap analysis concept, but what I really do want to say is emphasize something else. More explain what I do in the role that I have working with clients. It's more than saying, hey, I can offer you this product, I can offer you a MIC, or I can offer you a REIT. There's more to it, because once we've done a gap analysis, we will revisit that annually once a year. I do annual reviews, or as much as I can. And that's also why, quite frankly, I have a limited number of new clients I'm taking on. I just can't work with everybody per se, because I want to be able to have the time to do, an annual review, so we can say, okay, well, this was the goal we talked about in 2019. It's now 2022. What's changed in your life? Has anything changed? And quite often, oh, there's this thing called COVID hit. So there's two really important things I want to emphasize. The gap analysis allows me to almost, I would like to use the word coach, or we can revisit it. It provides a benchmark for us to always go back to make sure that you're staying on task, that you're staying on target with your goal. And it gives me that ability to look and analyze, okay, here's what we talked about, where we're going, how are your investments overall working, what do we need to rebalance? So beyond providing some investment opportunities for members, it also provides them someone who can help manage those investments as well. And that's one component of my role, my task. The other one, as an exempt market dealer, is the companies like AP Capital, which is a mortgage investment corporation, or Centurion REIT, Real Estate Investment Trust. These are corporations and companies that we, and I say we, my partner Harris and I, have really done our due diligence on. So one of the biggest challenges I would think that a lot of your members have is, how do you know, how can you do an analysis to know what's a good company, what's a bad company? And with all due respect, most people don't even know what to look at. You know, I ran my own MIC for a number of years, Mortgage Investment Corporation. I've been 25 years in the mortgage business. And I was joking with somebody the other day. I said, the guys over at AP Capital can't BS me. It's like, you know, I know how to open the hood on that car and work the motor. You know, I know how that engine works, and that's why we're comfortable offering it to our clients. And more importantly, if they stop doing, and this is really a really important thing I want to mention, because this is, I know everybody on the call's got a lot of you got a lot of options, right? But if you invest in a company and they're really good to start, but then internally they have a change in direction, and suddenly they start doing some things that end up creating bad results. You follow me on that? Mm-hmm. And how will you know before it's too late that their actions they took here created bad results over here? As an investor, how are you going to know that?
Yeah, unless you're completely, you know, tuned into them all the time, which we can't be, right? I mean, with the whole analysis piece, it's the thing that kills a lot of investors, really, because they either get analysis paralysis and don't make decisions, or they don't do any analysis and jump into things, you know, without knowing the risks and all of the big pictures, and so that again is where, when you get into the collaboration and you've got your experts working on your behalf, and, you know, using you as an example, Peter, right? Like that whole thing, like we know there's so many REN members that have worked with you that we like, know, and trust you. And that allows people who are coming into the group new to build that relationship with you faster, right? So it's that same thing that you're talking about. You've got that relationship with the companies that you work with because you've worked with them for a long time. And like you say, you know what's under the hood of that car. We know what's in your hood because we've been working with you for a while. So it's kind of that, you know.
Yeah, no, exactly.
Yeah.
Yeah, and a great example of that is, I'm going to use AP Capital, which is one of the companies we work with very closely. They're a mortgage investment corp, and they're just cresting over $200 million in private mortgage funds. And out of those, that 200 million, my partner and I have raised over 40 million of that. And so when we pick up the phone, and so two things. Number one, we do an analysis every single month. We also know that they have a credit facility with Royal Bank and with BMO, and those banks are also doing the same analysis, so we piggyback off those. But when I do my monthly checkup on them, I know exactly if they change there's certain numbers I'm looking for, and I look at the same numbers every month. And if all of a sudden I see a percentage out of whack, we pick up the phone and say, what are you guys doing? So you're never going to be in a situation as an investor that they started adjusting their parameters and all of a sudden the investment isn't what you thought it was. Right. So we do that with, and we also do that with every company we work with. And for that reason as well, we don't offer a whole slew of products. We keep the product offering very simple for one simple reason. One is, Liza, you'll appreciate this. I like to sleep at night. So I'm over here in Dublin. I'm doing research for my book. I love the fact that we've done enough research on the companies I recommend that I don't have to lie awake at night wondering if they're going to blow up on something and I'm going to have to deal with a major issue on the investment side, right? Because we've done our homework. And so it's the sleep at night test is very important to me. And I think that's the most important thing. But, that and the fact that we're constantly following up and checking on those, the individuals. And again, take this for what it's worth, but, I spent 25 years, in my opinion, building a good reputation as a mortgage broker, et cetera, in media and writing books. The last thing in the world I can afford or want is to start bringing on half a dozen just different investments and recommending things I'm not really familiar with, but they pay me well, and all of a sudden it blows up and I've ruined my 25 years of building a good reputation out the door, and can be lost quickly. So it's not the business model I like or want is to do that, right? So we're really comfortable with what we have.
That's great. That sounds great, Peter.
So anyways, on that note, Eliza, if you have any questions, please feel free to jump in and ask anything. Otherwise, what I was going to do is the real key points today I wanted to touch on was, just covering off the gap analysis really quickly, talking about the concept of non-correlating products. And then I wanted to jump in and talk about two companies that we work with specifically, and specifically what's happened over the last 7 months, because I'm really excited about it. And I think it needs to be shared, especially in the context of what's happening in the global markets. And so the two companies I want to refer to or talk about today are AP Capital, which is a mortgage investment corporation I already mentioned, and Centurion REIT, which is a real estate investment trust. And, the biggest thing I want to emphasize is that I know that a lot of your members have access to a wide variety of investment opportunities. And it's very difficult sometimes trying to compare apples and oranges. So I wanted to kind of help with that a little bit today. And, so two things I wanted to do is I will actually, I'm going to show an example of the metrics that I referred to earlier. And with AP Capital, we'll start there. So one of the things so bear with me here.
Yeah, and while you're pulling that up, Peter, and just for the benefit of the people on the call who are either new or haven't had the Peter experience before, we did record a gap analysis, so we do have that available for members. So I will find the link while we're on this call, and I'll make sure that it gets posted today. So if anybody wants to see more of Peter, they'll be able to see the other session that we did with Peter a few months ago. I think that was before he went to Ireland that we managed to.
It was, yeah. You
squeezed
that in.
We squeezed it in, yeah, and it's super helpful to do that. And Peter is happy to walk you through that gap analysis. So for those people who haven't done it yet and are interested, it's quite a great process to go through, and it's the plan, right? We need the plan. We need to make a plan. We don't necessarily always stick to the plan, but it's like starting to sail a ship without having the sails ready to go. You need to have the maps, you need to have the plan, and you need to know how you're moving forward, and you need to know where you want to end up. Just like you've said, you know, people just jump into real estate investing without really knowing where they're going. So it's great to lay that out and have that plan.
Absolutely. So this is what we call the Mortgage Investment Corp Fast Facts. AP produces these every month, and just kind of give you an example of a couple of things. And I wanted to really emphasize the apples and apples comparison versus apples and oranges. And before I dive into this, again, you know, everybody on this call has a lot of investment options at your disposal. I'd like to help you appreciate how some of the products that I have to offer might fit in and complement your portfolio. Okay, I'm not trying to say, hey, you should put all your money here. I'm trying to say these are good complementary investments, and you can invest through your RSP, your TFSA, or your corporation. A lot of people don't realize that you can invest corporate money or cash, and sometimes whether it's corporate cash or personal cash versus registered funds in RSP or TFSA, that will change my advice on what you invest in for tax purposes, because you want the highest tax efficiency as well. So let's start with the MIC, which is the Mortgage Investment Corporation. Think of this, and we talked earlier about the typical stocks and bonds portfolio. This would be your bond alternative. This is your steady Eddie. You're not going to have 10, 15% returns in this. It's going to clock along between 6 and 7%. Now, some people might go, oh, that's not very exciting. Well, but bonds aren't. You know, they're designed to be steady Eddie, safe, simple, and a proportion of your capital should be in something steady Eddie, safe and simple. But at the same time, you can ask anybody out there right now, and I deal with one of the top portfolio managers out of Vancouver with Industrial Alliance, and he said they are mandated at Industrial Alliance. He's mandated that he has to have a certain percentage of his portfolio, his clients' money, in fixed income meaning bonds, even though they're creating negative returns right now. He's mandated, he has no choice. But he's lobbied, and they're now bringing AP Capital on board as an alternative to bonds. So if you can imagine what a company like Industrial Alliance would do to go through due diligence to approve a mortgage investment corp, just try to think of that. Let's just put it this way. It's a lot more lawyers, money, time, and effort than you and I have to invest in that. So that doesn't mean you just say, okay, well, they approved it, we can jump in. But I wanted to touch on base on a couple of really important things. AP always starts off their newsletters with this. This is from June. Notice the first sentence there. This is the 148th consecutive month when they produced a dividend. And I think the lowest the dividend has ever been is 5.6%. So could you imagine, I know there's people out there who's tell me, you know, I take all the money I have, if I can get 6% return and paid monthly to me, that's all I need. And well, is this safe and secure? Well, they've been doing it for 148 months. So if you do that math, that's over 12, what is it? 12 years. Mm-hmm. So it doesn't mean it's guaranteed, but they're doing something right. What's really important is they have $200 million. That is spread out over 286 mortgages. This is really important to understand, because a lot of individuals, I know, Liza, you're working and you're doing an absolutely fantastic job on the private mortgage side, where, you know, people can lend you money, or you set it up so that individuals in REN can lend to other individuals. And if you know who you're working with, and you're working with good quality people and good quality projects, you can actually get a better return. But if you go outside of REN and you do that with people that you don't know as well, then it is really a buyer beware, because lending one-to-one, that individual you lend your money to, anything can happen. Health issues, employment issues, marital issues. I mean, there's so many different things that can go on in someone's life that can cause, through no fault of their own. I mean, yeah. COVID hit, right? You know, all of a sudden, you know, again, Russia invades Ukraine, and we have geopolitical issues. You never know. The point I'm making is, this is not what AP Capital is. They take this $200 million, they spread it out over 286 different mortgages. And guess what? Some of those mortgages are going to go into default. In fact, right now they have 2 mortgages in foreclosure representing less than 1% of the overall portfolio. The average, here's something really important though, the average loan to value on those foreclosures, 66.7%. So because these guys operate just like a bank, when those 2 mortgages go into foreclosure, it just, oh, that's simple. You just go through the process and they can go through the lawyers. It's just kind of an automatic process, and it goes through the system. The properties get sold, the money comes back. By the way, 2 really important things that are you have to understand about when we choose a MIC to work with. I want to make sure that MIC does not lend on raw land, development, commercial, or farmland. And the only reason we don't want the MIC doing that is because when they go to foreclose, those types of properties are difficult to foreclose on. So if the entire portfolio, as you can see here, 94.6% of the portfolio is residential mortgages. And why is that important to me? Because I know they can fire sale residential mortgages, and you as the investor are not going to be impacted. Because the other number I'm looking at is this one here, 50, the portfolio loan to value. Sorry, lost it. Portfolio loan to value, 58.2%, the second number from the top, or third number from the top rather. So what does that mean? It means they've got enough equity in the portfolio that if somebody goes into foreclosure and even if the market crashed, you as an investor are not going to be exposed. So remember I said earlier, there's certain numbers I look at every month. These are them. I'm just sharing with you some of the numbers that are really important to me and that I analyze. So I was talking with a REN member last month, and she asked me about this other MIC that provided a higher return. And I said, well, I looked it up. I did some analysis on it. First of all, they'd only been in business for about 5 years. They only have $70 or $60 million. So they're relatively small, which means number of foreclosures can impact them. And in these things, size matters, because the larger the fund, the less impact a few bad apples have. The smaller the fund, and I'll talk about that with the REIT as well, then you can be impacted. I'm sure a lot of people have had that experience. Here's something else that's really, really important, and I'll end on this with talking about the MIC. And Liza, I think you'll appreciate this. If a MIC will take 1.5% management fee, okay? So if they say they're giving you a 6.5% return net to you, that means the average interest rate they're generating will be 8%, right? Now, if you look at a MIC and the MIC is promising you 10% return, well, that means their average interest rate's 11.5. Well, guess what? That means, see these numbers here? Mortgages in first position, 83%. Mortgages in second position, 17%. I like that. That's the other thing I watch like a hawk. You know why? First mortgages are going to be easier to foreclose on and protect our capital. Because for me, this is all about capital preservation. Remember that thing I mentioned earlier about sleeping well at night? This is what I'm talking about. When I know over 80% of your mortgages are in first place, you know what? It's going to be really hard for them to mess this up. But if somebody starts to offer 10% returns, and again, I'll refer to the other mortgage investment corp that we were analyzing, and they're getting 10% returns, absolutely, because guess what? 85% of their mortgages were seconds and thirds. So when the market tanks, or if the market does have a correction, and you're not really well diversified, and you have a small pool of mortgages, and most of them are seconds and thirds, you're now vulnerable, you're exposed. Does that make sense?
Absolutely. And that's, just looking at these numbers, right? Like being in first position. I mean, that's the bank, like the bank is in first position, right? So when you're getting your seconds and your thirds, and I know a lot of people have heard about what's going on with Epic Alliance, right? And they had mortgages in third and somehow even fourth positions, which really isn't a mortgage at all. It's basically at that point it's a promissory note that's not tied to anything, with no security whatsoever. So yeah, that 83% funds in first position, that's a confidence builder for people, right? Once people
Absolutely.
know a little bit more about, what the whole investment picture is like, being in first position gives you a lot of confidence in your investments.
Yeah, and I like sharing this because, as I mentioned to you earlier, I don't expect everybody on this call to know how to analyze these. I do this for a living. This is my job to analyze this every month. And so, again, when you work with me, that's what you get with that comes with it. You get protection of your investment because you got a set of eyes that has a vested interest, right? And that's really important. And the last thing I'll say about this, and I just really excited. I've worked very closely with Chess Hagen, who's the CEO of AP Capital, and hopefully this makes sense to everybody. A mortgage investment corp actually can create a larger return to investors if they have a larger access to a credit facility, so a line of credit. Some people think, well, why would you need a line of credit? Well, in this business, that actually is a good thing, because the cost of capital is cheaper if they can use money from a line of credit or a credit facility. And so they can borrow money from the bank at 3.5%, lend it out at 7, 8, or 9, and the spread is profit back to you as an investor. So the other thing is, if you'll see here, they have $200 million in lendable assets right now, and shareholders. There's 1,200 shareholders. Okay, and so how, if you think about it, a MIC has a chicken and egg problem. If they raise a bunch of money, they got to get it out the door, right? They got to lend it. The more they raise, the more they have to be lending. So what happens if the market slows down and there's nothing to lend on, but you keep raising more money and you sit on cash? You dilute the yield back to the investors. So the biggest danger, and something else I watch for, is I always am afraid of smaller MICs where they're trying to satisfy a promise to their investor to keep a 7% return. And then all of a sudden the market slows down, but they're sitting on cash. So it's going to affect their yield. So what they do is they go on what I refer to as the skinny branches, and they start doing seconds and thirds, or commercial mortgages, or sketchy stuff that they know they shouldn't do. Well, the reason AP Capital never has to do that is because they've now negotiated a significant access to a really significant credit facility line of credit. So they can go $30, $40 million into the line of credit and then say, okay, we know they have that money lent out, so we'll go raise more money. And then the money they raise just replaces the line of credit. Does that make sense?
Totally makes sense. And when I think of that whole chicken and egg scenario, it's very similar with small investment groups, right? Like you get a group of people together and you're like, okay, we gotta, do we raise the capital first, or do we go find the property first, right? And so like that's the situation we're in right now with Crescent, right? We made the decision to buy it, and we need one more person,
Yeah.
But then the other thing is if you get the group of people together, then sometimes you're looking for the property for a long time. So when the property comes, you don't want to miss out on it, so you jump in. So it's that whole, what do you do first? Do you look for the property, or do you build the team? And usually it's somewhere in between there, and every scenario is different. But yeah, it's that finding money.
Sorry, that reminds me of one other point that's important on a MIC, is that when you invest in a MIC, you don't have to lie awake at night worrying about, well, what happens when the investor pays back? Like if you lend 1-to-1, and I know you've had this experience, Liza, when somebody pays you back, or if you're if you're the one lending the money and the person you give the money to, they might pay you back after 10 months. Well, now you got to find another mortgage. So you might have got a higher return, but are you getting that return 365 days a year, or is there month-long gaps where your money is not working for you? And these are, again, doesn't mean one's better than the other. It's just, I'm just trying to put context in here of how a MIC operates. You put your money in there and they worry about all that because there's 286 mortgages. So yeah, some are closing. There's new ones and old ones going back and forth every month. And what's important, these are only ever designed to be 1-year terms. So these aren't 5-year mortgages. They're 1-year terms. Get them in, get them out, get them in, get them out. So it's constantly adjusting. And the last thing I'll say about this though is going back to that operating line of credit, Royal Bank did a complete total audit. I mean, full on annual audit a couple of months back. And the result of that audit, as you can appreciate how, I mean, they looked under every rock, nook and cranny, analyzed. The end result was they agreed to double the line of credit facility. They were that impressed. Not only were they that impressed, they said, this is the max we can offer, but we're going to introduce you to Bank of Montreal. And they set up a 3-way call that Royal Bank pitched AP Capital to Bank of Montreal, which is unheard of. I mean, I don't know if that makes sense to everybody. Everybody gets it, but when I found that out, it made me realize how well run the management team is and the back end and the whole operation, because Royal Bank would never do that.
Yeah, that's a lot of confidence in the product and the way it's run and the due diligence and the forensic analysis that a bank would say, you know, this, we're at our max, but we want to keep seeing this succeed. So we're going to go to another bank and get them on board. That's a pretty good testimonial.
Yeah, exactly. And that's why I wanted to share it, because this is just stuff that you as an investor on the call, as a REN member, I mean, for the general public, you just wouldn't have access to you wouldn't have access to that information. B, you wouldn't know to ask about it typically, right? So these are just some of the things that we, again, just helping people understand the analysis that I do behind the scenes and why we don't just randomly say, well, this guy pays me good commission, so we chose AP Capital. It's a lot more to it, you know. And on that note, I'm going to shift and talk about Centurion REIT, because I don't want to take our call too long here. Almost the same kind of conversation. Centurion REIT is a real estate investment trust. Again, they operate as an apartment REIT, so they buy apartment buildings. This just basically is their quarterly statement. Again, returns over the years have been 8.4%, 70. They had some really good years there. Sorry, this line up here. At 17, 23, 21%. Those were unusual years. And then during COVID, you couldn't increase rents. So the worst year they've ever had since inception was during COVID. And even at that, it was 7.93% return in a time when you couldn't raise rents. And it bounced back last year. And catch this number, 8.49% year to date. This was after 6 months. So they just announced, anybody that's on my newsletter would have got the email yesterday sent out. They increased this to 10.2%. It grew again last month. If you go August to August, it was like, or sorry, what do we hear?
August, we're actually in August.
Oh yeah. So yeah. If you go to August to August, yeah, no kidding. If you go to August to August, take those 12 months alone, it was an 18% return for those 12 months. But anyway, they're performing really well, but that's not the really important thing I want to talk about. Buying into an apartment REIT really replicates owning real estate without having to be a landlord. And again, RSP TFSA eligible. And if you're using cash or through a corporation, the growth is treated as capital gains, and it pays out a monthly cash flow that's treated as return of capital. So it's the most tax efficient investment you could possibly make. Now, there are a lot of REITs out there, limited partners, small, some are large, but I want to really just go back to what we're talking about before that I mentioned with the Royal Bank example with AP Capital. Centurion is now, I think they're over 135, 140 properties. So you know what, if they have one problem in 2 or 3 buildings, it's not going to impact you as an investor. There's 19,000, let's just call it 20,000 rental units over 43 cities, Canada and the United States. Now, they now represent the single largest private REIT in Canada. Now, again, And by the way, if anybody's saying, well, how's inflation and rising interest rates and those things going to impact this REIT? Well, Greg Gromit is one of the most intelligent people I've ever met. He's the CEO and founder of Centurion. He wrote a white paper with his opinions and thoughts on all that. So if you're interested, send me an email. I'll send you a copy of the white paper. But again, you just look at the size of this, and Centurion's now at a scale and a size where individuals, and Liza, you may appreciate this, there are people out there who have portfolios of 20, 30 buildings, like family trusts, right? And when they go to sell that bulk of properties, they sell them as a unit. And by the way, what's interesting, a lot of those owners are older individuals now whose children aren't interested in taking it over. And a lot of those individuals found that the hassle that they went through with COVID, they're done. They just want to move on and get rid of it and cash out. So Greg was telling me that Centurion now, because of their size, it gets the first phone call on every one of those before it ever hits the market. So
Makes sense.
You, as Liza, in your role, could you imagine if you got the first phone call before anything ever hit the market?
That would be pretty amazing, especially when it's a portfolio like that, right? A mom and pop owner, you know, it's usually there's lots of opportunity to increase value in something like that. So those are the kinds of things that you want to get your hands on for sure.
Yeah, absolutely. And the last number here, I don't know if I have it here. Oh, I thought it was on there. It's not. But the size of funds under management is now $5.3 billion.
Wow.
And again, so all I wanted to say is, because I've had a lot of phone calls, a lot of conversations with REN members, and one of the common things is, well, that's interesting. I'm also looking at this other REIT, and how would you analyze the differences? And again, I can't emphasize, you got to make sure you're comparing apples to apples. And I'll just give one example. Won't use the company name, but there's a gentleman that was building a REIT in Alberta. God bless him. He's well-intentioned. I mean, he's doing his best, but it was Alberta and the market tanked there. And all he had were buildings in Alberta. So you know what? Two things happened. Number one, the valuation went down. Number two, when people started seeing that, they asked for their money back. And guess what? He had to say no. And he had to gate the fund and cap redemptions. And if you look at your offer memorandum, it was written in there that they had the ability to do that. Most of them do. So you look at that, and it's going to take a lot of people probably 10 years to exit out of there if they get their money back that they originally put in. Let's hope. But now you're totally dependent on those 12 to 15 buildings in Alberta coming back.
Mm-hmm.
Okay, does that make sense?
Yeah, and that's, you know, that's risky, right? Like having
Yes.
one location, you know, just as you've said, I did send, now is it Centurion that also started to venture into Mexico, or was that one of the
No, that was ICM, another company.
ICM?
But
Yeah.
they're actually redoing their offer memorandum, so we put them on hold until I've reviewed that.
Yeah. Yeah.
So again, all I want to do is really emphasize that it's the scope and scale of these companies. They're what I refer to as institutional companies. We talked about the Royal Bank analysis with AP Capital. Well, let me give you just one example. First of all, Centurion is approved on 75 different corporate shelves, meaning I'm one company, you know, our Diversify is a company, we've approved them, but so is 74 others. Those also include every charter bank, pension funds, and university endowment funds. If you had a list of the companies that have approved this to offer to their clients, you know, and you just think of the number of lawyers that have gone through all this. This company has, I mean, they are about as close as you can get to bulletproof. Okay, and I'll give you one example. Concordia University had their teachers pension fund, or it was their endowment fund that they were analyzing what to invest in. They took 18 months of researching Centurion And when they completed that research, they put over $40 million in. So this
That's a
is
lot of
what,
confidence.
well, you remember one of my number one criteria, sleep at night? That's the type of stuff that helps me sleep at night. So people always say, well, don't you have anything else? One last example. A gentleman emailed me yesterday and said, would you guys be willing to work with our company and raise money for us? And my first question, have you been approved, or are you already approved by a pension fund, institution, or university endowment fund? And the answer was, well, no, but I thought, fine, that's good. Just call me when you are. Because
Yeah.
I can't afford to allow my clients to be guinea pigs. So if you're not approved on an institutional level, then we really don't have any interest. So the last thing I will say to those on the call, you have a lot of options and a lot of places you can place your money. And some of them can be very enticing, and some of them will get better returns. We're not talking about this return's better than that return. All I'm trying to suggest is hitting home runs are nice, but sometimes you want to hit singles and doubles too. So it doesn't have to be one or the other. Create a nice mix and sprinkle in an alternative to bonds like AP Capital that's been kicking out a good 6-7% return for 148 consecutive months. Work with a company like Centurion that targets between 7 and 12% and replicates owning a rental property without being a landlord. But then also do the other things. You've got a lot of really exciting products that Liza brings to your table all the time. So again, it's not about one being better than the other. It's about analyzing your risk versus reward, and analyzing that sometimes it's nice to lower the risk and have some steady eddies in there, and then take some other money and take higher risk with that.
It's great, Peter. Awesome. It's so great to be going through the opportunities just with two companies, right? Like if you want to have some balance in your portfolio, you don't need to do a lot to get that diversification. I mean, as you say, we've got lots of people in the group who are private lending. We've got lots of people who own property, who are landlords, right? I mean, Lori and Joan and I have had some head banging against the wall recently over being landlords, and then there's other times when it's great. I mean, we've got an executive rental Airbnb, and I'm the host. I love hosting people, so welcoming people from around the world who say, oh my God, your property's gorgeous, right? There's all of these different things that we can do. And some of them bring us joy, and some of them are painful. And then somewhere in the middle, you find some balance, right? And so it's nice to be able to add a couple of pieces of investment opportunities that diversify your portfolio. And I think that's exactly what you're bringing to the table. We love Peter. There's quite a few people that we work with. And you've heard me say this before, people who we know they have our backs. We know that they know that we've got people at all ends of the scale. With our REN members, we've got people who are women in particular who haven't started investing yet because for whatever reason they're either sitting on equity, or they haven't just had the opportunity to get a real estate or even in a general investment opportunity. And so the more we can kind of help everybody move forward with knowledge and feeling safe, Peter is again one of those people you can feel very safe with. So he's not going to shame you, he's not going to embarrass you, he's not going to say that's a stupid question, right? He's going to have a good conversation with you and help you understand if the investments that he offers through his organization, through his company, are the right fit for you. And he gets to know people on a personal level. So it's great to have Peter on the team, and I'm grateful for your support with REN, and I'm grateful that you have our backs, right? We know you have our backs. We appreciate that.
But, you know, and I think what you're doing is just a fantastic job, you know, and Liza, you know what, again, we met, what, 7, 8, 9 years ago, and just watching the growth of Rend and the empowerment of the people as part of the group, and it's great to see, and it's well needed. It's a valuable service you're providing there. So
thank you.
good
Yeah,
on you.
we like it. We sure love it. We're having fun, and we're you know, I think one of the other things too that we haven't talked too much about today, you know, but the gap certainly reflects on that, is the whole lifestyle, right? Like the people who join Ren usually are joining us for a couple of key reasons. Number one, they want real estate and investing to have an impact on their lifestyle so that they can either, you know, become work optional earlier in life. Or, you know, many of us want to be able to live in other places. And I think a key thing that we're all discovering in this, you know, I'm calling it the new world that we're living in, because we had the new stuff that we had to get used to during COVID, and now we've got the new stuff that we're going into right now with the whole market changes. So it's the new world, you know, that we're living in. And we know that we can work remotely. I believe that Eastern Europe just released a new nomad visa, and we've been talking about those where if you're earning your money from your home country, the world is going to completely open up to you, and you're going to be able to go and live in other countries. And as long as you're spending money in that economy, right? You're, you know, as an author, writers have been able to do this for a long time. You've been able to almost go anywhere in the world and write a book, because you're not taking money away from that economy and you're spending money in there. And now that's opening up to the whole digital nomad section, right?
That's an interesting, theory. I should practice that theory one day.
Yeah, right. So it is that, you know, we're moving to that place where we get to go and work anywhere that we want to in the world. And as long as we're spending money in that economy and earning our money from home, we can go and live somewhere where it's cheaper. And so that's where your gap analysis, right? A lot of people have this misconception that they need like so much money to have a great life. And I know when you do the gap analysis, people are often surprised that it's like, oh, well, if I'm planning on going to live in Mexico when I retire, you know, and I have these assets and I've got this coming in, I don't actually need as much money as I think I do. So it's really good to know that, you know, sometimes that number, yes, in some cases you need more, but in a lot of cases you actually don't need as much as you think. And those 5, 6, 7% compound returns can get you there if you're starting at the right time. Yeah.
The biggest mistake most people make, they go for higher returns and then they get hit with big losses. Again, I do all my math based on a 5% annualized return compounded, but consistent. And, you know, I try to be conservative with that, and 9 times out of 10, that's all they need. And if I could share one quick story that really touched my heart, you mentioned being able to live and work anywhere. You know, I had a situation where very dear clients of mine, and by the way, part of doing the gap analysis and working with you as a client, we develop a good working relationship over time. I get to know my clients, and I have almost a emotional investment in it as well. And this couple was from Alberta, had real estate, worked with them way back in the rain days, getting their mortgages. And unfortunately, she ran into some major health issues and had to go to a forced retirement. And her husband decided to do the same. They have decided to pull up roots, liquidate all their real estate, move to Portugal. And working together, we were able to put together, through a gap analysis, a business plan that's going to help finance and fund the rest of their lives. And if they hadn't purchased that real estate way back, they wouldn't be in the position to be able to have the luxury and freedom. And what I love about that is, you know, they're actually going to earn more cash flow through things like the, you know, between 6 and 7% yields off of AP Capital, and the yield that they get from Centurion and other investments like that. Those yields will finance their lifestyle in Portugal.
Amazing. Yeah. So, and that is the kind of thing that we're seeing. And that's the kind of thing, and especially as women, again, right? As women who are going to be, you know, retiring eventually. And everybody on the call knows I talk about these stats all the time. 56% is the average age of a widow in Canada. It's remarkably young. It's a scary statistic. Women are likely going to be single for up to 30 years in their retirement. So where are you going to spend that, right? Are you going to spend it in an expensive country like Canada, you know, continuing in a job? Or are you going to be one of the women, you know, who are in the Ren group who are like, no, we're going to go and own a house together in Mexico, and we're only going to have to, you know, have this much money to be able to do that. So it's all of those things that, you know, we've got the boxes that we work in with the banks and with our jobs. And then we've got things like the gap analysis that help kind of blow that box open a little bit and get us really thinking about what we want for our future. And then how do we get there, right? And really working that plan on how we get there. So awesome stuff. Love it. Does anybody have any questions for Peter? I know there were a couple people who had to dash off. A couple people are going to be calling you, Peter, that haven't seen you before. So few new members who I know were really excited about hearing this, and we'll be in touch with you. I know Melanie in Ottawa is really keen on getting in touch with you and starting her whole real estate journey. So she's just been she's one of those people who's just dove in and ready to go. So
if anybody wants to talk about doing the gap analysis, I do have some criteria around it, just because for respect to my time, we send you a form to fill out ahead of time, and then you know, send that back so I have a bit of an understanding where you are. And then, you know, again, it is designed to be, you know, if I spend an hour doing it, that means we're working together as a client relationship. If you're looking for just a kind of a quick Coles Notes, I can do it in 10 minutes as well. So, you know, but yeah, just send me an email directly. That's peter@peterkinch.com.
I'll pop that in the chat. And I know that we've also got your information on our, and I've got, I posted in the YouTube video here. So there's, I just posted that in the chat. That's the video that we have for members only. It's unlisted. So you can obviously go in and see that. That's Peter walking us through the gap analysis. And just give me that email address again. It's peter@peterkinch.com. It's pretty easy.
Yeah, I like to think so.
Yeah. Okay, so I put that in there as well. And yeah, Peter, thank you so much. It was great information today, and great to see that, again, in these times when going out and buying the single condo or the single apartment building or the single family home are a little bit scary for a lot of people. It's nice to be, again, it's that diversifying, right? Don't put all your eggs in one basket, get that diversity going. So that's awesome. Cool.
Yeah. Hey, listen, thank you very much. It was a pleasure. And I want to wish everybody a good August.
Yes, August is going to be busy. It's a busy month for us. And of course, everybody that we need to be in touch with is on vacation. So that's just the way it is. And I'm going to Memphis, St. Louis, and Nashville on a little bit of going to Graceland for the anniversary of Elvis's death with my mom, and Sherry Krause is coming with us as well. So we're going to Graceland, we're going to St. Louis to see Keith Urban, and then we're going to Nashville to
that's fantastic.
do some music stuff. And you'll be in New York soon.
I leave for New York on Sunday.
Yep, excellent. And congratulations on the book. I know we're super excited to see how it all comes together, but I think it's just so exciting that you've gone and done all of this research and gone to Dublin to write this, what are we calling it? Historical fiction, is that right?
Historical fiction, yeah.
Yeah, historical.
And I won't get into it, but it's been life-changing for me. It's been an amazing thing. And as you and I talked about before the call, you know, when you are in alignment with what's your true purpose, I guess, and the universe will align with you. And when that happens, it's just you just feel humbled and blessed, and it's like miracles happen. It's absolutely amazing.
Yeah, it's the universe telling you are exactly where you need to be.
Yeah, it's very exciting.
Exactly.
And the beauty of what we talked about earlier is with technology, it doesn't matter where you are now.
Yep, exactly.
You can still work.
We just get the time zones right? So
That's right. Yeah.
in the evening, but that was going to be 3 o'clock in the morning for you. So that's okay.
Yeah, exactly.
Switch the time zone. So we record it and everybody can watch it back. So Shannon had a question about explaining the difference about share classes and how they affect returns. Is that a fairly quick answer?
Really quick. Usually what happens is there's two share classes. One is working with someone like me. I don't charge fees to you. There's no cost of working using, I get paid commissions from these issuers. If you worked with a portfolio manager, then, or some of the like F-class shares would be institutional shares. So you can get those through a portfolio, but then you have to pay a fee to them. So the return is actually better with us because there's no cost.
Yeah.
So that's that's the easiest way I can explain it.
Easiest way to explain it. And once everybody who reaches out to you gets to have one-on-one time with you, there will be deeper conversations to be had for sure.
Well, that plus there is one other small thing. If you to get access to the F-class shares, I think the minimum investment's $1 million.
Okay.
Because they're usually, those are the shares offered to institutions,
right,
when they're buying
the endowment lands and the
they're buying $40 million worth at a time. So it's we refer to what I do with my clients is referred to in the industry as the retail level as opposed to the institutional.
Awesome, cool. All right,
and I hope that answered the question.
Perfect. Good stuff. So thanks everyone. Just a couple of quick things while I've got a minute. I think I mentioned we're at Our Place tomorrow serving breakfast and lunch to the Our Place Society. So if anybody wants to make a donation, the cost for that was about $1,200. And I think we're at 8 right now. So we just need a couple more donations to come in to pay for that. Lori, myself, Carolyn, and I think a couple of other people are going to join us serving breakfast and lunch to a group of people in Victoria who really need access to some healthy food. So let me know if you want to join or send a donation and I'll get that organized for you. I mentioned September 24th, so save that date. We've got a panel of experts who are going to be speaking about real estate and investing and lifestyle. That's going to be at the Langford Business Center. So that's a full day event on September 24th. Peter, you're still away, aren't you?
Which was the date? September
24th.
Yeah.
Yeah, you're still away.
So 24th, I'll be in Savannah, Georgia. Nice.
Oh my God, I love Savannah. We will probably get Peter over and we'll do an event when he comes back. And we can have some of our Vancouver friends come over to Victoria. So we'll organize that probably in the new year. Couple of other things. We've got our happy hour, obviously, for Victoria next week. And then August in general is going to be a little bit quieter on the Ren front, just because everybody's on vacation. So we're not going to do our August 17th, which is usually our Crown Capital day when it's an open session. Because so many people are on holidays. And as I mentioned at the beginning of the call, Jeff is going to be with Donnie Dunlop up in Grand Forks. She's got a whole bunch of really interesting properties that he's going to get some drone footage and get some more information on. We will obviously have started selling, as I mentioned. We've got our Souk properties, our 10-acre parcels that are for sale. We've got 4 10-acre parcels. We know that those are going to be quiet until probably September when people start getting used to the new normal and thinking that, okay, time to start moving again. I've got 1 spot left at Crescent. So if anybody wants to come and join us in this gorgeous beachfront 8-unit apartment building, we've got 1 spot left. And if anybody else has anything that they want to share or they want to tell us about or they want to send us, shoot me an email or post it on the Facebook page. And let's just make sure that everybody continues to move forward and has momentum. There's a lot of momentum right now, right? We've talked about this, uncertainty in the market, but we as people who are, seeing this opportunity, that Warren Buffett quote again, Peter, be fearful when others are greedy and greedy when others are fearful. And, don't get afraid when things get tough, right? Just hunker down, make sure you've got the right people on your team. And look at where you are and do the right analysis and make decisions not based on what the news media is telling you, but based on the full story, right? Look at the whole picture, rather than just looking at the headlines. So that's what we do together, and that's why I love this group, and I love having people like Peter coming in and joining us and helping us to move forward. So I think that's it for me. So thanks, everybody. Thank you again, Peter, and have an awesome day. And we will see you either at the happy hour or at the next event. Thanks, everybody. Bye.